Do you want to invest in property without actually buying a physical house, without having to deal with tenants, broken boilers, this tax, that tax, all this headache? Well, there's a way around it where you can actually earn real estate without physically putting yourself through the pressure for having to save up a big amount for your deposit, for having to think about dealing with tenants and everything broken in the property. There's something called a REIT, R-E-I-T, which is Real Estate Investment Trust. So these are basically companies that already own real estate. Many of them will own things like office complexes, private properties, commercial properties, retail properties. They already own them in their portfolio, and all you're doing is buying the shares of this company, and by default, whenever they get the rent, by law, they have to pay you 90% or more of the rent that they get from their tenants. You don't have to do anything. All you have to do is buy the shares. Every month, every quarter, every year, whatever it is, they'll deposit your little cut of the rent into your account, and you can live off that. You can reinvest it. You can do whatever you want. So in this video, I'm going to break down exactly what REITs are, where to find them, where to buy them, how to analyze them, and more importantly, how to invest in them and make the most of them. So first of all, what's REIT? As you all know, real estate is very powerful. But in this day and age, it's so difficult to be able to get on the property ladder. By the time you pay stamp duty, you get your deposit, solicitors fees and all that, you need thousands to even get started. So to be honest with you, for most people, especially the younger generation, it's a non-starter, especially in a place like London or big cities. So how do you get around this? You can simply invest in a REIT. Now, with the REITs, they're called Real Estate Investment Trust, as the name suggests. So these are real estate investment companies that buy or manage or fund real estate projects. Many of them will actually own them and have tenants in them. So they might have a warehouse somewhere that Amazon rent from them. For example, they may actually own office buildings, and the majority of them will already have all these properties in place. All you have to do then is to find them, screen them, make sure they are in line with what you want, and then just purchase them. So in this video, we're going to go step by step. So one of the advantages of REITs as well, if you live in a place like the UK, is that you can buy them into the ISA, which is the individual savings accounts, which means that they're completely tax-free. Any income you make from those, you don't have to pay taxes on. If you live in places like the United States or Canada or all these other countries, they'll have equivalent wrappers that protect your investment from tax as well. So it means that rather than having to work your 9 to 5 and you're earning money and you're paying taxes, you can actually earn income this way, and your income is actually protected from taxation. So that's one of the powerful things about REITs as well, if you buy them within those tax efficient wrappers. If not, then, or if those kind of wrappers are not available where you live, then you need to actually consider the tax implications, because some of them will be taxed differently in different jurisdictions. So just bear that in mind. Right, with that being said, let's go find these REITs. Let's find out where we can buy them from, how to analyze them, and let's see how we can invest in them. So I'm going to jump in on my laptop. So I'll share my screen now. If you go on my screen, you see I'm using Trading 212, which is my preferred platform. There are so many platforms now. So there's Invest Engine, there's Hargreaves Lansdown, AJ Bell, there's absolutely tons. So you do some research, find the one that's perfect for you. Make sure the fees are low. Make sure you can find one with free commission if possible. The foreign exchange fees, make sure that they're as low as possible, and make sure the platform is simple enough, easy enough, well laid out, so you're not scratching your head trying to figure things out. Right, so I've gone with Trading 212 because for me it satisfies all these needs. Now this is my Trading 212 platform that I set up for Roadman Investor. This is purely so I can do videos like this, and as you may be able to see, I've already got different things set up on the side there. So you got tech there, you got UK dividends, stocks, banking. I've already set that up, but I'm going to ignore all those now. I'm going to pretend I'm doing it from scratch. So once you go on the landing page like so, you want to go onto the search area, and On the left hand side, you see all these options there, different subcategories. So right from the top, you see it says big tech, EU, defense, all sorts, quantum computing. If you keep scrolling down, you see the ETFs there, and then down a little bit more, you got regions, and then more list, you see REIT. So if you just click on REITs over there, it'll give you all the REITs available on this platform. Now, if you're using a different platform, then they may have a different function, or it might be laid down a bit differently, but most platforms will have that. Otherwise, we can hop into my trusted friend, which is the Just ETF tool. But this will only give you ETFs rather than individual REITs. So we'll do that after this. Right, let's find individual REITs. So for example, if you're looking for UK specific ones, you can see on the right hand side, it's got the different flags. It tells you where they're based. So you got something like the primary health property. So this REIT is a UK based one, and from the name, as the name suggests, it's one that is primarily based around the healthcare sector. So if you scroll down, you can click on the full profile tab there, and you can read what the REIT is about, what they do. So this is a leading investor in modern healthcare properties in the UK and Ireland. This one is based specifically around healthcare investments in real estate. Okay, so that's one there. Now the good thing about REITs is that typically they're quite high, they pay high dividends, because by law they have to pay 90% of their income as dividends to their investors. So in this case, this is paying 7.83%. So if you're primarily interested in income, then that's a very good return for you. You look at the PE ratio, remember 25 or above is seen as expensive. 25 or below is seen as reasonable or low. So this is only 12.38, so it's a low PE ratio. The average volume, so that's how many is traded regularly, and then the market cap, so this is 1.21 billion. So that's how many stocks there are times the current stock price. So that tells you how big the investment is, and then it shows you the volatility. So this is low volatility. So volatility just means how much the price of the stock goes up and down. So this one doesn't go up or down very much, so it's relatively low. If you look on the price range there, so in the last year, the last 52 weeks, the lowest price we've seen was 85p and 37, and the highest we've seen is 105.47. And then in the last day, the lowest was 88.64 and the highest was 90. So you see that the prices don't move an awful lot, even within a 52-week range. So you can just have a look in there and just make sure that you're happy with that. Now, another thing that I do with any investment I make is to just check the performance. So as you can see, this is not done as well in recent times. Okay, so even though you're getting nice dividends, the investment itself is 15% down overall since it started, and over the past year is 6.98%. So if you take that into consideration, that you're earning 7 point something percent in dividends, 7.83% in dividends, but then you're losing around 7% on the stock price, you're actually losing money. Well, you're not losing money, but you're not making an awful lot. So you're only making about 1% in total returns. So you want to think about things like that. So don't just go purely based on the dividends. You need to think to yourself, what am I making overall? So with this one, it would be a pass for me personally. Let's look at something else. So maybe something like Realty Income, which is by far the biggest and the most popular one. So again, if you look at Max there, you can see that overall it's up by 6.12%, but over the past year is down by 4.73%. And if you just have a look, you can see that this was done better than the previous one that we looked at. And then if you look at the dividends on this, so this is 5.4%. So that means that over the past year, you wouldn't have done as well. However, if you look overall, you see that this is quite a volatile one in comparison. So we'll look at a different one again. Let me have a think. So if you look at Ellington Financial, so this is one I'm familiar with, you'll see that this one's done a lot better than those two that we've looked at. So I'm doing this on purpose just to kind of call your attention to it. So don't get drawn just purely based on dividend yield. Look at the overall performance of the REIT or any stock or investment that you're about to make. So overall, this one's 33.14% up, and over the past year is 4.79%. So that's growth on the capital itself, so the money you invest itself. And if you look over the past 3 months, over the past 1 month, over the past 1 week, over the past 1 day, so this is a much better performing REIT than the other one. Don't forget, this is just one company, one REIT that owns different properties. Now, as you can see, that's one that I'm already invested in, so that's my average line. So I'm actually already making a bit of profit on this one, but I'm just using it as a teaching one. So since I started investing, it's 4.93% up. So let's just pretend that's not there. Let's analyze this together. Let's look at some key information that we want to look at. So low volatility, market cap is $1.3 billion. The average volume is quite good, 1.09 million. The PE ratio 9.35, so very low, and the dividend yield is quite high at 11.28. So including this 11.28 dividend yield, you're also going to get this appreciation. Now, obviously, previous performance has absolutely no bearing on future performance, but it's just good to know that this REIT has actually done well, which means that you might have a bit of comfort in thinking, well, maybe the people who run it know what they're doing, but it doesn't necessarily mean that that's going to carry on, so just bear that in mind as well. But I'd rather see some sort of growth as well as good dividends rather than just going purely on high yield. Right, so say for example you're happy with this is what you want to go with. You simply click on buy, and then you decide how much you want to invest. So with this one, you can invest as low as £1 in it. So with the market order, you simply click on review, and then it gives you the summary. So how many shares, the the value of the shares. Because it's trading 212, it's commission free, but some platforms will actually charge you for the transactions, so bear that in mind. So this is REIT in US dollars, and we're buying in pound sterling, which means there's a difference in the FX. So this is the FX rate that they're using, and that gives you a total of that amount. So if you want to invest in that, you just click send buy order, and you'll go. Now, because it's the weekend, this will not execute until Monday, and it tells you there when the market opens up. Now, also bear in mind that because it's a market order, you won't necessarily get this price. All the system will do is go away and try find you the shares you want at the price close to that price on screen. So it may well be a little bit above, so it might come out to be $13.90, let's say, or $14 even. So if you don't want that, you want something a bit more guaranteed, you can simply click on limits, and instead of going by the market order, you tell the limit order the maximum you want to pay. So for example, it's currently $13.78. If you want to put a limit order there, you could put something like, I don't know, $13.90. And what that means is, rather than executing at the best price available, which could be a little bit above what you want to pay, you could tell the system, this is the maximum I want to pay, and then you tell it how many shares you want to buy, and then the process is exactly the same from that point. You just review the order, it'll give you a summary, and then you execute the order, and jobs are good on, as to say. So now, if you wake up on Monday morning when the market is back open and that's been executed, you'll have your stock of a REIT. So that's one individual company that's invested in several different properties. So you're now a landlord by default, and you'll also get the the rents from these people. They'll pay the tenants will pay the REITs will pay you, and by law they have to pay you at least 90% of their income as dividends. So all you have to do is now sit back and monthly, quarterly, whenever it is they pay, you just sit back and get the income from them. Right, so that's one way of buying REITs. The second way of doing it, instead of buying just the one REIT, you can buy the ETF that contains a number of REITs. So rather than just the individual company, which can carry risk in itself, because if that company doesn't do well, like some of the ones we looked at earlier, that could drag your investment down, and you can actually lose money. So to provide yourself with a bit more diversification, you'll have an ETF that bundles together a number of REITs instead. So you could do that in two ways. So again, using Trading 212, if you go up this time, you look on the left hand side, it says REITs there. There's a bit there that says, sorry, it says ETFs there. On the left hand side, it says real estate ETFs. So this gives you all the different ETFs that bundle together real estate instruments. So the question then is, which one do we go for? So as you can see, there's quite a few there. So this is where I then jump onto the Just ETF website. So on the Just ETF website, you can type in, for example, real estate. And then this gives you a little bit more information and different options. So once you type in real estate, you can just search that and it'll give you all the results. So first of all, I normally sort by total expense ratio. So total expense ratio is the price that the fund manager, so the guy who's actually putting the ETF together, the guy who's managing the ETF on your behalf, they'll charge you a tiny fee per year. So as you can see, for example, this one is 0.14. That means that for every £10,000 you invest, they'll take £14 from you. So that's very low. So once you've arranged them in that order, you typically look at the performance. So as you can see, many of these have not done really well recently. So let's look at the rest of them. Let's scroll down a bit. Let's see if we can find some that performed a little bit better. So over the past year, that's down, that's down, that's down. So we got one here that's performed really well at 7%, and you got another one there at 6.8%. So let's check those out. Let's see what's in them. So once you click on that, you scroll. Let's have a look. So the current price is around £18.76. You can see the performance. It's had a bit of a tough time also, but it's done well comparable to the others. Year to date, it's up. 5 years, it's not gone long enough, but in the last 3 years, it's up by 2.7. Don't forget that in addition to this performance, you're also getting the dividends. So talk about dividends. Let's scroll down a bit. Let's find a bit more information on it. So this is a accumulating one. So in this case, they wouldn't pay out. They'll just, rather than paying out the dividends, they'll just automatically reinvest it, and they'll just buy more shares of this ETF for you. For myself and for many people, that might not be the way to go, because the whole point of an income producing ETF is to be able to gain access to this income. So an accumulating version might not be the best for you. So let's sort by the distribution as well. So you want to bear in mind that these are all designed to do different things, right? So we've decided that we don't like that one because it's accumulating. Let's try a different one. So this one's performed well as well over the past year, 6.8%, and this one is actually distributing. So let's see what's in that one. Right, so we've got it there. That's the current price. Let's have a look at the charts over the past year. We know it's done well over the past 3 years. It's not been going long enough. So year to date it's 12.16%. Overall, it's done well. And let's get a bit more information. So this is one based in Ireland. It's distributing. The expense ratio is relatively high for an ETF, 0.45%, but that could probably be justified given the given the performance that we just saw there. It's a relatively small fund size at 1 million pounds. But let's assume we're happy with that, and let's just go into actually investing in this particular one. So what you want to look for is the ticker symbol, which is WNEW. So you just go back to your trading 212 or your platform, and then you search it to see if it's one that's on your platform. And as you can see, it is. So let's say we go in there, just check it out on your platform, make sure that it's one that what you think it is, because you might have made a mistake typing in the wrong ticker symbol, or you might have just picked the wrong option or whatever. So just make sure it's the right one, make sure everything makes sense. So it's the same name. You look at the performance, you look at the charts there, you can see that overall it's done well. Always try to get something that's got even though it's got that dip there, you can see that it's bounced back quite nicely. Let's then look at the yield. If we scroll down on this, so it's they pay the dividends twice a year, but they haven't declared the dividend yield. I think it's because it's a relatively new fund, so that's not been determined. You got the 1 year performance, you got the 2-year performance, 3-year performance, and let's have a look at what's in them. So again, with it being an ETF, you don't just get the one instrument, you don't just get one REIT in there, you get a number of them. So this one tells you the top 10 holdings. If you want to see them all, you just click on see all, and it tells you every single instrument within that. So you got American Tower Corp, Digital Realty. So with this, you're not investing in just the one REIT, you're investing in a number of real estate companies. So but simply by buying this one ETF, you now own exposure to all these different companies that are real estate investment companies. Right, so we're happy with that then. Let's say we're going to go with it. Let's go back, and again you scroll up to find the buy button. Over there you click on buy, so you now have the option of market limits. Again, for the sake of this video, we're not going to talk about stop or stop limit. We're just going to either do market orders or limit orders. So market orders, you just type in how much you want to buy, so maybe £1, maybe that's all you've got. You review the order, it'll give you a summary, and then off you go. That's the summary right there. So you can tell it's a market buy, number of shares, the value of the shares, the commission, and then the total. Alternatively, if you want to go by limit, you tell the system the maximum you want to pay. So it's currently 1,756 pence per share. So for example, you want to pay no more than 1,760. So same way, you use the slider, and then the system will go to work for you. Once the market opens, it'll try find anything close enough to the amount that you've put there, and then you'll have the peace of mind of knowing that the price, if it goes up by the time the market opens, and it goes beyond the amount that you've put there, you won't buy anymore, it won't execute, so you're not overpaying. But conversely, if the price goes up massively and you missed out on that and it carries on going up, then you might have missed out. But that's just the way it goes. You have to bear these kind of things in mind. So depending on your circumstances, you might just be happy to just put a market order in and let it do its thing. But if you think, okay, I've got a price that I want to pay and no more, then use a limit order. But once you put that in, when the market opens, you'll be a newly invested property owner. And that means that over the next month, quarter, whatever it is, you get your nice slice of dividends from them, and you're now going to be able to either reinvest that money or take it out and buy something else with it, or pay your bills with it, or actually live off it. And the good thing about this is, if you buy it in an ISA wrapper, it's completely tax-free. You don't have to worry about paying VAT, capital gains tax, income tax, nothing, because the ISA covers it. So we've gone on a bit. We've covered quite a lot of information. So REITs are real estate investment trusts. These are companies that own properties. The properties could be retail, could be commercial, it could be industrial, it could be healthcare, it could be different sectors. And you buy the shares of this company, and as a result, you'll also be an investor and an owner in that company. That means that whenever they get paid rent by their tenants, they'll pay you your cut in the dividends. By law, they are required to share at least 90% of this income with their investors. So the yield tends to be quite high. You don't have to worry about being a landlord yourself. You don't need to worry about the boiler breaking. You don't have to chase any tenants about maintenance, nothing. Let them do the work and you get paid. So this is actually another pure form of passive income. Just put the money in. You can dollar cost average, so that means every week, every month, wherever it is, you can just put more money in and let the money grow and accumulate. When they pay you the dividends, you can reinvest that to buy more shares, so next time you get even more dividends, and so on and so forth. So the video's gone on a bit, so let's just wrap up here. If you've got any questions, leave it down in the comments below. Make sure you like, subscribe, make sure you actually share this, let people out there know about this. There are people dying for this information. Let's get it to them. And don't forget, it's a Roadman Investor. So join me next time.